You so much, Dr. Wang, and good morning and good evening. Thank you for having me today. It's a great pleasure to be with all of you. Let me share my screen. Okay. So, you know, we have also released just our report last week, the China Economic Outlook, where we take a closer look at China's economy with a special focus on what is happening in the real estate sector. So I have extensively elaborated on the global picture. Of course, this will also have an impact on China, but I will focus also on the domestic headwinds that China is facing, and there are quite a few that are worth outlining. So some of the messages I wanted to flag is that China actually started the year relatively strongly. In January, February, things looked pretty good, but then we have seen this large COVID outbreaks in Shanghai, and they have disrupted China's growth normalization. And on top of the COVID outbreak, China is also facing a slowdown in the housing market, which is an important sector for China's economy. And on top there, the external shocks due to the war in Ukraine, which is also weighing on economic activity in China. And given all of these headwinds, we have actually revised down China's real GDP growth for this year to 4.3%. And this marks a downward revision of 0.8 percentage point relative to our China economic update that we had released back in December. And the downward revision really largely reflects the damage caused by the Omicron outbreaks. And even with this growth projection, we still see a number of risks which are unevenly balanced, and they are skewed to the downside. I think the main risk is that we have further COVID shocks that could disrupt economic activity. There's also the risk of more persistent stress in the real estate sector, which could also weigh on the economy. And then there are the risks related to the global outlook that Ayhan just presented. However, there could also be an upside risk to economic growth. And this upside risk could materialize if the COVID situation is controlled more effectively, if economic disruptions are of lower magnitude, and if there are fewer COVID restrictions, then we can see growth being potentially higher than what we currently envisage, helped also by the additional stimulus measures that the State Council announced about 2 or 3 weeks ago. But in the near term, I think the main challenge that China is facing is how to mitigate COVID while also supporting economic growth. And one of the concerns we have is that as outbreaks continue and mobility restrictions persist, this could limit or reduce the effectiveness of policy stimulus. And then over the medium to longer term, there is a risk that China remains tied to its old playbook of stimulus-led investment, whereby policymakers ramp up infrastructure investment and real estate investment. But this risks that China might end up with more debt in the future. To achieve high quality growth, it's important that decision makers strengthen efforts to rebalance the economy more towards consumption, more towards services, towards green industries, and assign a larger role for markets and the private sector. So just very briefly, as I mentioned, China had seen this large COVID outbreak, which has really severely disrupted economic activity. On the positive side, the outbreaks have gotten under control relatively quickly, but we do continue to see recurrent outbreaks, and even though the situation in Shanghai has started to normalize, there are still many restrictions, mobility restrictions in place that continue to hamper economic activity. Ayhan already alluded to the commodity price shocks and the tightening of global financial conditions, so I will not go into this. Now, for the first quarter, China was still able to, record a relatively robust growth rate, despite the deteriorating global environment and despite the impact of new Omicron outbreaks. And the rebound in growth, as you can see on the right-hand side, was really predominantly driven by investment, and especially by a recovery in infrastructure investment, helped by strong policy support, but also robust manufacturing investment. In contrast, consumption has stagnated due to deteriorating consumer confidence, a challenging labor market, and also due to the tighter mobility restrictions. We don't have the Q2 growth data yet. They will be released in a month from now, but we do have higher frequency activity data. And clearly you can see that towards the end of the quarter, the Omicron shock had a pretty large impact on economic activity, which was very broad-based and affecting both the supply side, but also the demand side. And similarly, we also looked at some of the mobility indicators. On the right-hand side, you see an indicator that measures truck freight flow. And you see that while in many places this indicator has recovered, in Shanghai it's actually still, points to still tightened mobility restrictions. The outbreaks in Shanghai and the lockdown in Shanghai have also impaired trade activity. As you can see here, following a strong first quarter, export growth has actually declined sharply in April, but figures that have just come out actually show a small rebound in May. Similarly, due to weak domestic demand, import growth has also contracted in March and remained flat in April. But we've seen some recovery, modest recovery now in May. Overall, we find that the commodity price shock actually has had a limited impact on China's trade balance, even though China is a net importer of energy commodities. So China essentially stepped up its domestic production of key energy products such as oil, gas, and coal. One area that I think worries us is the deteriorating labor market situation, where we have seen quite significant increase in the unemployment rate across different measures, both headline unemployment rate has increased, but also youth unemployment rate has also increased substantially, driven both by the pandemic, which has affected the demand and supply side of labor. And as you know, the upcoming graduation season this year will release a record number of fresh graduates of almost 11 million graduates in the labor market. And so far, the economy has generated less new urban jobs in the first 4 months compared to last year. With all of this in mind, policymakers have embarked on aggressive policy stimulus, especially fiscal stimulus. The budget that was released, this year's budget that was released in March, according to our estimates, points to a fiscal stimulus of up to 2.7% of GDP. It could be a little higher if you add the recently announced measures. But most of these measures focus on the supply side. They're also geared towards ramping up public infrastructure investment through the issuance of local government special bonds. Monetary policy easing has been a bit more modest, with most of the policy support directed towards window guidance, which is targeting credit to priority sectors, while at the same time trying to avoid an increase in debt. In addition, policymakers have also introduced a number of measures to support the real estate sector. These include easing home purchase restrictions, but also a cut in the 5-year loan prime rate, which is the interest rate that serves as a proxy for mortgage rates. Still, despite the regulatory policy easing, we see that the housing market still faces a lot of challenges. Home sales, whether you look at volumes or values, remain in deep contraction. And similarly, access of many property developers to debt markets, whether it's onshore or offshore, remains limited. So with all of these headwinds, we project the economy to expand by 4.3% this year. And this is significantly below China's potential growth. And there are a number of assumptions that feed into our growth projections. First, we assume that China's current COVID strategy will be maintained this year. We also assume that COVID outbreaks will continue, but they will be of less disruptive nature, as China will hopefully become more effective in handling these outbreaks. Still, we envisage that activity will normalize only very gradually because of weak confidence and also declining exports. So we don't assume a V-shaped recovery. And lastly, we also don't assume additional fiscal stimulus beyond what has already been announced. Now, when you look at the composition of aggregate demand this year, we envisage a shift in the structure of aggregate demand more to domestic demand. Last year, net exports played an important role in supporting China's economic growth. This year, we see less growth impulse from net exports. As Ayhan mentioned, the global economy is projected to slow significantly. But within domestic demand, we'll see more of a shift towards investment, helped by the government's fiscal policy stimulus, which should support infrastructure investment. As I mentioned, there are a number of risks and downside risks to our outlook prevail. First of all, there is the risk that we could see prolonged COVID outbreaks that could impair both the supply and demand side. And in such a scenario, it will be difficult for fiscal and monetary policy to really offset the impact on economic growth, because in such a scenario, such stimulus could be more less effective for the reasons I had mentioned before, and instead could lead to a buildup of further financial risks. Second, there could also be more persistent stress in the real estate sector, which could also, which could also lead to wider macroeconomic and financial repercussions. And then lastly, the war in Ukraine could also lead to much larger external shocks. It could lead to higher energy prices for longer, lower global growth for longer. All of this would weigh on China's growth outlook. All this said, however, we also want to flag that there is an upside risk to our growth outlook. And this upside risk is that if COVID is controlled more effectively with fewer restrictions, then growth could be higher thanks to the recently announced additional stimulus measures. Lastly, I want to also flag a number of medium-term challenges and longer-term challenges that China is facing. And first, of course, is the handling of the pandemic, on which I elaborated during my presentation. Then there is the property market slowdown. But as you know, China has also been facing stagnant productivity growth. It's facing demographic headwinds. The working age population is slowing. A number of local provinces are straddled with high levels of local debt. And China also needs to tackle inequality. So all of this said, I think China, and this is something we have flagged in our previous reports as well, that if China wants to achieve high quality growth, it needs a different type of growth model. It needs one that gives greater emphasis to consumption, to services, green industries. If China continues on the current path, there is a risk that leverage debt increases further, especially corporate sector debt among property developers, but there's also the risk that debt in many local governments is also increasing further, and this would limit policy room going forward. But first of all, I think what is critical is that China needs to plan for an exit from its dynamic zero COVID strategy. With this, let me end and thank you again for giving me the floor today.